Hello, everyone. Hello, everyone. I am Kim Hughes, and this is the January 3rd edition of Sane Crypto Live. If you are popping in as a replay listener after the fact, I really appreciate you being here, hanging out, seeing what I am up to. Today's topic is, does risk even matter in a cryptocurrency portfolio when everything seems to be going up? But before we get to that, let me just give you a mercifully brief snippet about me. I like to say this is not my first bubble. I'm a 20 plus year investment industry veteran, former investment advisor and money manager, as well as Wall Street critic. I'm an author, a speaker. I'm an inventor of an investment method for creating retirement income, which I went on to turn into an award-winning investment firm that was at one point number 826 on the Inc. list, and which I sold last year. So just to get a feel for folks, I like to ask a question of the day. So today's question of the day is, very quickly, where are you from? And what has been most frustrating for you about either investing in cryptocurrencies or learning or even considering investing in cryptocurrency? If you would put that in the comments below, that would be super, super helpful. And now on to the topic at hand. Okay, which is a topic that I have not covered in a long, long time. And based on a comment that was left on my Facebook page yesterday, a topic that some people aren't familiar with, which is risk-adjusted return. So most amateur investors make the mistake of chasing returns. And in the world of cryptocurrencies, this manifests as investing in the hot altcoin of the moment, or investing in cheap coins so that you can buy more, so that if it pops, you can make more. It's trying to day trade or swing trade. And chasing returns is a rookie mistake that eventually turns out to be very, very expensive. When you focus on performance numbers alone, return number, right? We are focusing on this number, which is just an average return over some period of time. You may hear a number in the press say, like, Bitcoin went up 303% last year. Which it did, or some altcoin has doubled in the last week. And the problem with that number is that it leaves out risk. So in a crypto portfolio, right, there are many considerations that you want to think about when choosing which assets to invest in beyond just the return. Okay, which might include, fees and scams and the risk of being hacked, just to name a few. But those are not what I want to talk about today. Those are topics for another day. Okay, what I want to focus on here is this concept of risk, and which seems to have been kicked to the curb in the in the bubble environment that we're in. Okay, so there are two approaches to risk. One is to just ignore it completely and hope that it doesn't bite you in the butt, right? Sounds like a good strategy, doesn't it? But the second is to actually manage risk and returns as two interrelated pieces of an equation. And this is the way that big institutions, foundations, trusts, pension plans, and insurance companies, people who are all in the business of making money for themselves and their clients, manage their portfolios. It is also how we manage a sane crypto portfolio. Okay, so let's just start with the basics. The definition of risk is the standard deviation of return. In other words, okay, what does that mean? Unless, if you're a math major, you know exactly what that means. But for the rest of us, it means how much variability is there in that return. Okay, because the line from one price to another is never straight. Okay, so how much variability, how much up and down is there mathematically? Okay, and that's the standard deviation, and this is how risk is measured. So let me give you an example. Imagine that I have two different tokens, two crypto tokens, okay? And both have had a return of 35% this month, okay? But one has had a standard deviation, one has a standard deviation of plus or minus 90%, okay? Which means that 2/3 of the time the return would fall somewhere between 125% and minus 55%. And the other token has the exact same return, but its standard deviation is only plus or minus 30%. So that means 2/3 of the time that return would fall between 65 and 25. Okay? All things remaining equal, which do you want to own? You want to put your answers in the comment box? All things remaining equal, two tokens with the exact same return. One has a standard deviation of plus or minus 90, okay, and the other is plus or minus 30. Which do you want to own? Well, okay, the correct answer is B, okay? Now, let's talk about that, right? All things remaining equal, the correct answer is B. So that's the token with the 35% return and only the 30% standard deviation. If one job of the investor is to make sure, maybe I might argue, that he or she gets the maximum amount of reward for each unit of risk taken, which by the way it is, and I started to say, and I might argue is the job, not just one job, okay, then the appropriate way to view performance is to take the two competing variables, risk and return, okay, and put them together, which is something called risk-adjusted return. Now, so risk-adjusted return looks at how much return did you make for each unit of risk that you took on. And it can be measured in several ways, okay, but the most common is something called the Sharpe ratio. It's a formula, a fairly simple one. You can look it up. I won't bore you with the details now, okay? It's more the idea for the moment that I want you to understand. If I look at one portfolio that's returned 70% and another that's returned 50%, and all I look at is the return percentage, I would think the 70% portfolio was better. Okay, but think again. If the 70% portfolio has a risk level of plus or minus 90%, and the 50% portfolio has a risk level of only plus or minus 20%, on a risk-adjusted basis, the 50% portfolio is actually better than the 70% portfolio because of the consistency of the return. And if you'd like to know more about the value of consistency in absolute dollars, because it actually does matter in a meaningful way, you can, I'll refer you, I'll put a link in the notes to a really, really old post that I wrote ages ago called The Fred Fiasco. The example refers to equities, not crypto, but the principle still holds. If you want to get those notes, you can go to sanecrypto.com/risk and find the notes for this particular episode, including that link. Okay. But so crypto sycophants who get more listeners and views and buyers and whatever, by continually refilling your cup with Kool-Aid, will seldom talk to you about risk, right? Oh, what a wet blanket, what a party killer. But it's all fun and games until somebody gets hurt. The only way to measure two investments or two portfolios side by side is to compare them on a risk-adjusted basis. Otherwise, you're you're comparing apples to oranges. And the irony is, over time, by chasing higher returns, you will actually, over time, make less. That's how it works. Okay, so just to sum it up, okay, just because you look at an altcoin, for example, and see higher returns there, does not mean that's the better investment. Okay, that's the message. Hopefully that was helpful for you. I do these broadcasts every weekday at roughly around this time, sometime, around 10 o'clock Eastern time in the United States. If you would like to be notified when I go live via Facebook Messenger, so not only that I'm going live, but what the topic is, so you can choose whether to tune in or not, just go to sanecrypto.com/live and then type in the word live, and the bot will get you on that notification list. Also, if you did find this helpful, leaving that in the comments below, along with any questions that I can answer, any thoughts you have, comments, etc. It would help a lot if you would leave that below, as it tells either Facebook or YouTube, depending where you're watching this, that I'm publishing valuable content and that it should be seen by more people. I would really, really appreciate that. Again, I mentioned it earlier, but you can get the show notes with links to the resources, including the Fred Fiasco post, and a tool about how to calculate how fast your money doubles at various rates of return at sanecrypto.com/risk. And remember, disclaimer, everything that I've said is for educational purposes only, should not be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, especially these. It could go to zero tomorrow, someday will. So do not, under any circumstances, invest money you can't afford to lose. Thanks for listening. I'll be back to Thursday, tomorrow, with another installment of Sane Crypto Live. Until then, y'all, please remember, pigs get fat, hogs get slaughtered. I'm Kim Hughes. Now go forth and conquer.